Hey, what's going on everybody? Welcome back. It's Travis here with JT Wealth. In today's video, we're going to look at the 4 best ETFs you can invest in today for high dividend yields and to set yourself up for early retirement, which is super important. So let's get into it. Alright, like I said, welcome back. Thank you so much for joining us today. Hopefully you find some value in today's video. I'm super excited to bring this information to you guys. I took a little while setting it up and just going through the process of pulling all this information together. I got really excited and I knew that you guys would as well. Very few jobs outside of the military right now offer an actual retirement after 20 years. So if you're a young kid, maybe 20, 25 years old, even 30 years old, whatever the case may be, if you're looking at how you can retire early, say within a 20-year time frame, there's not a lot of great options available for you. That is, unless you take this into your own hands and invest in your future. So today I'm going to show you the best 4 ETFs that I personally feel will set you up for success for an early retirement within a 20-year time frame. All 4 of the ETFs we're going to talk about today are dividend-focused ETFs, meaning you're utilizing those dividends via DRIP or dividend reinvesting plan, as well as compounding growth and whatever capital gains you're receiving as those ETFs appreciate in value to increase your savings and your future retirement. So before we get right into today's video, as always, please don't forget to check out the links in the description section down below where you can find links to things such as a new investment platform where if you were trying to set up a dividend investing portfolio, you could use things like M1 Finance, which is my favorite for dividend investing and retirement planning. If you use the link in the description section down below and fund your account with $100 within the first 30 days, you'll get a $30 free just for signing up. You can also consider joining our Patreon group where you'll have access to our Discord chat group where if you have any other questions on retirement, the FIRE community, or whatever they may be, you can ask those questions in the chat group and get direct responses from me or from other people in the chat group. Alright, so this is a super exciting video. I'm really stoked to bring it to you guys. Let's get right into today's topics. So something I just want to address right from the get-go. A long-term wealth creation strategy doesn't have to be complicated. Everybody's always seeking for the get-rich-quick scheme or whatever the case may be. That might not be the best approach for everybody. Sure, it's going to work for maybe 1% of folks, but for the average person, here's what you need to do. Number 1, live below your means. Number 2, have minimal debt. Number 3, invest in dividend funds. And number 4, let DRIP or the dividend reinvesting plan and compounding interest go to work for you. If you're unfamiliar with dividends and what they can do to your account, let's take a look at the S&P 500 with and without dividends and you'll see exactly what I'm talking about. So this chart shows the power of dividends and compounding. It took a $10,000 investment from 1960 all the way up to 2015. And you can see the yellow line is just the S&P 500 price only, no dividends at all, okay? And after that time frame, you were looking at $10,000 all the way to $351,735, which isn't bad, right? Until you look at the S&P 500 total return with reinvesting those dividends, okay? So that $10,000 in the same time frame turned into almost $2 million. That is a significant increase just by adding those dividends and reinvesting compounding interest. And here's another super simple way to look at the version of investing with dividends, with dividend reinvesting, and with compounding interest. So this super simple chart shows dividends in value from 0 all the way up to $10,000 and years from 0 to 30 years. So in your blue line, you have only dividend reinvestment, assuming no dividend growth, okay? And you're seeing some progress there. But your red line, now you've got only dividend growth, but you're not utilizing the DRIP, no dividend reinvesting. You're making more than only the dividends with no growth, but are you making as much as you can? No, not even close. Look at that green line. That's your double compounding line. That's receiving dividend reinvestments and dividend growth at the same time. So you're obviously looking to utilize that green line in your future investment plans. Okay, so before we get into which 4 ETFs I looked at today, I'm going to show you guys which dividend calculator I used to come up with the information that's going to showcase your 20-year return and your future retirement plan based on those 4 ETFs. So let's take a look at that now. Right off the bat, this dividend calculator comes from the MarketBeat website, okay? And it allows you to put in some fantastic information to create your perfect dividend calculator. So I'd used a portfolio with a taxable account. These distributions pay out frequency as quarterly because all 4 of the ETFs we're going to talk about later are quarterly paying. Then you select DRIP Yes so that you're reinvesting those dividends. I utilized a starting principal of $20,000, assuming that maybe if you took your total investment accounts in however many you might have and merged them all into one, you've got $20,000 to start with for your account today. An annual contribution of $12,000. That assumes you're putting $1,000 a month into your dividend reinvesting plan so that you can plan for a faster, smoother retirement plan. I recognize this is aggressive, but this is what you would need to do to set yourself up for a successful retirement within a 20-year time frame. Okay, the dividend tax rate, they estimated at 15%. I left that right where it is. Your annual dividend yield, for the purposes of this video, I'm having it set at 2.98%. And the reason is I took the 4 ETFs and all of their annual dividends, added them together and divided by 4. That landed us at 2.98. Okay, expected annual dividend increase percentage per year, I just left that at 1. Most of these are dividend aristocrats, so they are increasing their dividends every single year for at least 20 years. Expected annual share price appreciation. Now, for this specifically, I was very, let's just say conservative, okay? The lowest we had with this in the 4 ETFs was 9.98. We had some 11s, some 12% as far as their 10-year share price appreciation. So I went with an average of 10 for dividend share price appreciation. Okay, so that's kind of your capital gains rate right there. And your years invested, 20. So let's see what all of that information turns out to be in 20 years. So if you started with 20 grand and invested $1,000 a month for the next 20 years, what do you think you would end up having at the end of that 20-year time frame? Well, if you said anything under $1 million, you are wrong. After 20 years, your ending balance would be $1,182,579.22 for a total return of 354.84%. Your average annual return is over 17%, and your annual dividend income is $43,590.45. The total you made in that 20-year period just from your dividend payments alone is $244,489.33. So imagine that. You started investing today and you did so in a very aggressive way, $1,000 a month into the ETFs we're going to talk about shortly. And within 20 years, you've got $43,000 a year in dividend income alone. But that's not all. I know that sounds infomercially as heck, but check this out. You've now got $1 million portfolio, right? And the rule of 4% says you can take out 4% of your portfolio every year without actually diminishing the value of that account at all. So with $1 million account, in this number specifically, you can pull $47,000 from that account annually without diminishing the value. So now you've got $43,000 and $47,000 for a total of $90,000 a year in income you can withdraw from your account 20 years after you start. So hopefully I have your interest and you're curious, which 4 ETFs can I start investing in today to get myself to that level where I can retire in 20 years or less, depending on how much it costs me to retire. Everybody's got their number, right? But let's get right into which 4 ETFs I'm talking about and utilizing for today's numbers. Number 1 on our list, ticker symbol VYM. This is the Vanguard High Dividend Yield Index Fund ETF shares. Okay, it's trading at 106.76. And you can see here, I've showcased the last year-to-date numbers. That is successful ETF numbers, okay? We were down below $94 in the beginning of the year, and we're up to $106 today. The top 10 holdings for VYM include JP Morgan Chase, Johnson & Johnson, the Home Depot, Procter & Gamble, and Bank of America. As for VYM, it has an expense ratio of 0.06% with a dividend yield of 2.84%, and it tracks the FTSE High Dividend Yield Index. There's over 400 holdings in there, and they include sectors such as finance, healthcare, tech, utilities, and telecom. They have a 10-year return of 11.89%, and year-to-date they're at 17.64%. So obviously we're not just talking about dividend appreciation here, but we're talking about capital gains appreciation as well. The second ETF we're looking at is ticker SCHD, or Schwab US Dividend Equity. They're trading at 76.72 as of earlier today, and again, their year-to-date is up significantly. Within the top 10 holdings are the Home Depot, IBM, Pfizer, Pepsi, and Texas Instruments. SCHD has an expense ratio of 0.06% with a dividend yield of 2.81%, and they track the Dow Jones US Dividend 100 Index. There's over 100 holdings, as the name would suggest, and those sectors include finance, healthcare, infotech, industrials, and consumer staples. The 10-year return here is estimated to be about 15.56%. And I say that because it came out in October of 2010, so we haven't quite reached a full 10 years yet. But year to date, they're at 17.02%. So that's our second company to have about a 17% year-to-date appreciation, right? And both stocks or both ETFs are doing increasingly well in that 10-year time frame. Next stock on our list is ticker symbol SDY, or the Spider S&P Dividend ETF, trading at 125.56. This one almost mirrors the other two for the year-to-date time frame, increasing as we go along. The top 10 holdings here include ExxonMobil, AT&T, South Jersey Industries, Chevron Corp, and IBM. SDY has an expense ratio that is higher than the other three at 0.35%, but their dividend yield is 2.58%, and it tracks the S&P High Yield Dividend Aristocrat Index, which, as we know, means they've been increasing dividends consistently for over 20 years. They have over 100 holdings, and those sectors are finance, healthcare, industrials, utilities, and consumer staples. With a 10-year return of 12.9%, they are year-to-date at 19.15%, which is our highest year-to-date so far. But as you can tell, all of their 10-year averages are definitely beating the 10% I used to be fairly conservative in the calculator. Alright, and our final ETF for the day is ticker symbol HDV, and that's the iShares Core High Dividend ETF, trading around $98.03. Their year-to-date also mirrors the other three, increasing as the year goes on. Their top 10 holdings include ExxonMobil, Johnson & Johnson, JP Morgan Chase, Verizon, and Chevron. HDV has an expense ratio back at our normal levels at about 0.08%, with the highest dividend yield so far of 3.7%. This company, or ETF as it were, tracks Morningstar Dividend Yield Focus Index. They hold over 75 holdings, and those sectors are finance, healthcare, energy, and consumer defense. The 10-year return here is 9.84%, and year-to-date they're at 13.21%. So I know I went through those fairly quickly, but I wanted to bring you guys this information as fast as I could so that you could see first and foremost the import of that information and how you can utilize these 4 ETFs to set yourself up for retirement faster than the average person or people who aren't looking to do the same. Personally, I wish I had this information when I was 20 or 25 years old and could have set myself up for success a whole lot faster. But when you finally get to the point where you've decided that FIRE, or financial independence, and retiring early is important to you and your family, and you can set aside $1,000 a month to do so, this might be the perfect opportunity for you to set you and your family up for that 20-year retirement right now. So if you're looking to have $1 million account and about $90,000 a year to spend towards your early retirement, this might be just the video you were looking for, and I hope that it really helps. In the event it did, and you found some value in today's video, Please don't forget, give me a big thumbs up and consider subscribing to the channel if you're not already. Thank you guys so much for checking out the video. I really appreciate it. Please leave a comment in the comment section down below. Let me know what you think about these 4 ETFs individually. Where are you at with your retirement planning? Are you looking to retire early? Is your investment set up for success? What's your plan and how are you implementing it? If you have any advice for anybody else, let that be in the comment section down below too. We're all sharing as much information as we can to help everybody out, right? So thanks again so much for joining us, and until next time, take it easy.